Everyone. Appreciate your being here with us on St. Patrick's Day. I hope you've all got your green on to celebrate the day. And if not, we're going to talk, that'll be okay. We are going to be talking about state tax credits and incentives. And let me introduce you to our speaker. And if you'll go ahead, forward a couple of slides there. And there we go. Yes, so our speaker today is Ann Yancey. Ann is a director with our practice in this state and local tax group. She is our national leader for tax credits and incentives, even though this says incentive fees. If I paid attention to my spell check, I probably would have gotten that right. But today, Ann is going to cover an agenda that talks about, well, really why credits and incentives, what's new and trending with them, what can we expect going forward, how they might take shape. We're going to walk through updates. We're not going to cover every program in every state, but Ann's going to guide us through some of the changes that are taking place, and some of these changes are so new, they've hardly been in place for not less than 90 days. Then we'll talk a little bit about federal credit, tax credits, and available. And then as we have time, we're going to try to answer questions as we go through. But at the end, we'll have time for your questions as well. So, Ann, let's go ahead with the first section here, which is all about why are there credits and incentives? And I'll let you address that question.
Okay, thanks, Sarah, and good afternoon to everyone. Really excited about this topic and the environment that we're in right now. I think what we'll see going forward is that credits and incentives are going to become even more important as companies are looking for cash. They're looking for opportunities to reduce their tax liability. So let's get started. So why credits and incentives? These are really vehicles that are used by the state and local governments to encourage a particular type of behavior. They're used for economic development, but I like to say that credits and incentives are really a recruitment tool that the states use to attract business projects to certain areas of the country or certain communities. So the types of activities that the states generally want to see and that they're trying to encourage, they want companies to invest in new operations or to expand their existing operations. And there's sometimes a confusion that companies think, well, we're not expanding. But that definition is very loosely defined for credits and incentives purposes. And it's not just meaning that you're adding square footage to your office space or to your building. Expanding can mean just adding or creating new jobs. So in that context, you should think about it in that way. It could be adding a new product line. It could be a company that's winning a new contract and now we have to add new employees. Or just market demand dictates that we add new jobs. So those are also expansions. Again, I mentioned adding and creating new jobs. The states want jobs that have higher wages, obviously, for its workers. They want companies to invest in property, plant, and equipment, to conduct R&D, and to invest in R&D activities, to train the employees and increase those skill sets of its workers, and also hire disadvantaged workers. We'll see tax credits on the federal side related to disadvantaged workers. And also states want companies to use the port activities in that state to import or export products. And all incentive programs, whether they're tax credits or non-tax incentives, are really geared toward each state's individual targeted business industries. Now, the industries that we have on the screen here are going to be the most commonly utilized industries that really every state wants to come into their communities and into their jurisdictions. So these are the most common targeted industries. Some states are going to have very specific industries that they want to cater to that are not on this list, but again, these are the most common utilized programs. You will find that a lot of tax credits are very specific to NAICS code. That's our NAICE codes that are used. And so I find a lot of times that companies may have multiple NAICE codes. They may be using a NAICE code on their tax return that's not really descriptive or indicative of the actual business that they're in. And so it's also worth looking at that description to see whether you are utilizing the appropriate NAICE code that will allow you to be eligible for tax credits. State incentives really come in two forms. There's statutory and discretionary programs. Our statutory incentives are what we commonly refer to and see as our tax credits. You'll see the different tax credits listed on the screen. These are incentives that are in the tax law. Any company that actually meets the provisions of the tax law and qualifies for that particular program are eligible to take these credits. Generally, these credits are claimed on the business tax return at the time of filing. And compare and contrast that to discretionary incentives, which are generally our negotiated incentives. So these are for projects that the state has to approve in advance, where the state will award a company potentially one or more of these incentives, such as cash grants, property tax abatements, sales and use tax exemptions. Some companies may ask for free land, they get training grants, or any type of financing that might be available for the state. These programs all have what's called a but-for requirement. And what that means, the state is looking for that company to justify to them that without this particular discretionary incentive, the project would not occur, or that this incentive that you're going to give me is going to be a major factor in my decision to move forward in this particular state. Also, with discretionary incentives, your project must be competitive with another jurisdiction. So that could be another state or it could be another country. But generally, the state agencies are looking for competition in order to justify giving and awarding a discretionary incentive. Again, I've mentioned that the projects must be approved in advance, and you must enter into a project agreement with that state or locality. And the hardest part about discretionary incentives is actually getting in front of that project, because your project, your hiring, your signing of leases cannot occur until after you've signed those agreements. So if the state gets wind of you already starting a project in their state, or they already anticipate that you're going to come into their state guaranteed, then you may lose your opportunities with discretionary incentives. Okay, so Sarah mentioned some of the trends that we're seeing in the credits and incentives world. And you'll see some of these examples as we talk about some of the state updates. What we're seeing now, in the past, there's been a lot of state tax credits that could be utilized against the corporate business income tax. What we're seeing now are incentive awards that are more performance-based incentives. And what that really means is that the benefit or the incentive is not awarded to the company until after that project commitment has been met by the company. So if you commit to the state that you're going to spend $5 million and bring 50 new jobs, the award is not given to you. That cash grant is not provided to you until after you've hit those performance targets. The second trend that we're seeing is that the states and the localities are looking at their own return on investment and aligning the company's incentive award with that ROI. And we're seeing this more often. California is an example of this, whereby the states are asking companies to answer a myriad of questions regarding, why is this incentive necessary for your business? Prove to us that you really need this incentive. How is it going to be used? They evaluate a series of criteria to determine, well, what's the state's benefit or anticipated benefit over a period of time as a result of awarding this company this incentive. Are their suppliers going to come with them? Are they going to bring additional business into the state? And the incentive award that they are granting is, again, aligned with that return on investment. We're seeing monetizable tax credits, and those are tax credits that can now be utilized against things like payroll tax or sales tax or excise taxes, where companies can get a more immediate benefit than just utilizing those credits against income taxes. So we see a lot of companies that are still in net operating losses and are not able to take advantage of certain income tax credits. And with the states moving toward monetizable credits, companies can now either, again, use them against payroll taxes. They may be able to sell those credits to generate cash for the company, but we're seeing that in a lot of states. We're also seeing states move toward incentive award allocations. An example of that is Virginia, and what that means is that the state funds a program for a particular amount of money, and they let all the applications come in for that particular program. They give a deadline for that. Once they see the total population of applicants, then they determine the amount that can be awarded to each applicant based on the size of the projects. It could be based on the number of applicants, but ultimately it's based on how much funding do they have in the pot that can be given out to each taxpayer. Virginia does that with almost all of its programs. They are holding companies, again, accountable for those commitments that the companies are making, again, whether that's a jobs commitment or an investment commitment. We're seeing an increased scrutiny around holding companies accountable to those provisions, and if they do not meet those commitments that they've promised, there are recapture or clawback provisions in those agreements, which causes the company to have to pay some of that money back if it's a grant, or pay back tax credits or other types of recapture provisions. And lastly, the states rather are trying to be a lot more transparent in disclosing what companies are being awarded incentives, how much are they being given, and most states now have on their website, you can go to their annual reports and you can actually see who's been awarded certain dollars.
All right, let's get to our first poll here. This is just a check-in to make sure that you are present. If you would like CPE, check yes. If you are not concerned about CPE, check no. Or you can ignore this poll question altogether. So, Ann, I've done some work with research and development credits on the federal side, and pretty much most states are offering that same credit or a similar based credit on at the state level. And we're seeing some of both. The credits are limited in total, so that each applicant may only get a portion of that total pot if it's oversubscribed, and also an ability to use credits against something other than income taxes, which is very valuable in particular for startup companies or companies that are not generating terrific profits at the moment, but have high expectations. It's a way to help fund and move them forward. All right, I think we're about done with that poll. Hope everybody's had a chance to check in. We'll give you just one more minute, one more few seconds to finish closing that out. And okay, let's close that poll. And Ann, walk us through some of the states. Like I say, we're not going to go through all the states, but just hitting the high points of what's going on with particular states and their new programs.
Okay, absolutely. Thanks, Sarah. Yes, we're going to be looking at any technical changes or amendments to existing programs that are out there, and also introducing some new programs, anything literally that's happened within the last tax year, current to date. Okay? All right, let's start with Alabama. We are seeing in a number of states where state Department of Revenue or taxing agencies are now requiring companies to pre-certify tax credits and requiring them to do so on a state-mandated system. So in Alabama now, the majority of business credits now must be claimed through the My Alabama tax system. The MAT system is what they're referring to that system as. So you see there's really the majority of the business credits now have to go through the MAT system beginning January 1 of 2020. And how that really works is, for Alabama, they gave a deadline of March 15th, which has passed in this case, but it's a suggested deadline. There are no penalties if you did not meet that deadline, but they want companies to go ahead and file their credits on the MAT system as soon as possible. That gives them time to look at the credits, approve the credits, so that by the time the company actually files the tax returns, they will be in the state system, and it should hopefully be an easy process. But once the Department of Commerce approves your tax credits, then the taxpayer should get a web notice or some type of an official letter saying that your credits have been verified, and therefore the credits can then be claimed on the tax return. Alabama also had some major changes, and those that are familiar with Alabama know that their new legislative sessions always come out with a new tax act. And the one enacted in June of 2019 is called the Alabama Incentives Modernization Act, or the AIM Act. And it had a number of tax credit amendments and components to it. So we'll highlight the major ones. And a lot of these amendments are to previous acts. So one of the prior acts is the Growing Alabama Credit. And they've made amendments to this program. This program is really a piggyback, as Sarah mentioned, to some of the federal programs around the Federal Opportunity Zone. So just as a reminder, with the Federal Opportunity Zone program, if an investor invests in a project in an opportunity zone, they get a deferral of a capital gain benefit. Well, Alabama has replicated that program, and they are also conforming to the state provision and giving a state capital gain deferral as well. The other piece that's really interesting about this amendment to the Opportunity Zone program is that the Alabama Opportunity Fund that an investor invests in can also negotiate with the state of Alabama, and the state can award what's called an impact income tax credit to the fund. And this is a credit against income tax or franchise excise tax. What the state is really essentially doing with this credit is really underwriting the fund, and what it does is allow the state to look at the opportunity zone, and if it does not meet expectations, performance expectations on what was agreed to in the original agreement, then these credits really offset the risk to the investor. So essentially they are guaranteeing that the performance that's expected on the Opportunity Zone from the Opportunity Zone Fund actually occurs, and they do that through the issuance of tax credits. The Alabama Department of Economic and Community Affairs is going to govern this process. It is an application process. It is competitive. And it's something that has to be negotiated up front, and it has to be in the fund agreement. Okay. Also, Alabama modified the Jobs Act, and there are two components to the Jobs Act. There are jobs credits and there are investment credits. Both of these programs are really lucrative in that either there are cash back rebate credits, or the investment tax credit is an income tax credit, but it can be sold for cash. So the changes to the program are that the state has now defined what the definition of a targeted county is and what the definition of a jumpstart county is. And they've made some provisions to those areas. Now, if your project is in a targeted or jumpstart county, only 10 jobs are needed for this program. It was previously 25 new jobs, and the benefit is a 4% of the gross payroll of those new jobs. So that's a change as well. The items in red are modifications. All other counties, again, you see you need 50 jobs, and 3% of payroll is your tax benefit on the jobs credit program. The other new component is the technology company component, headquarters credit. And really the state is looking to attract high-tech companies to the state. They've made some provisions to define who a technology company is. And they basically say that it has to be a company that's headquartered in the state where 3 of the top executives reside and 75% of the employees reside in order to get that benefit. And the change to this program is that the benefit to a technology company has now increased by 2%. So now the credit is a 5% of gross payroll credit. And again, on the investment tax side, the only change to this component is that now a targeted or jumpstart county project now must spend at least $2 million in order to get an investment tax credit that's 1.5% of the qualifying cost. And again, you'll see these other industries. The other important factor here is that chemical manufacturing, data centers, engineering, design, R&D, machining, technology, and tooling, there is no minimum number of new jobs that's required for this program. This is a program, again, that has to be approved in advance, so there is an application process here. I'm just going to briefly mention this Railroad Modernization Act just took effect as well. It's a refundable credit, which is really good, but I don't know how many railroad companies we have out there or manufacturers that have installed rail spurs or have any type of railroad rehabilitation expenses, but to the extent that you do, there is a new credit that's 50% of those qualified expenses, up to a maximum of $3,500 per mile of rail track that's owned or leased. Again, there's an application process. This credit, I mentioned that it's refundable. It's either refundable or it can also be sellable in whole or in part to another party. There is no carry forward on that credit, though. Okay, Arkansas. Arkansas has some modifications to the Consolidated Incentive Act. What they've really done is expand the definition of eligible business. So you see here a listing of who the targeted industries are that were already listed in the legislation: manufacturing, agricultural, food and environmental sciences, information technology, transportation and logistics, and bio-based products. They've added new NAICS codes for additional life sciences for film and media, air and rail transportation and support. The other change is that the business now must derive 51% of its revenue from out of state, and that's down from the previous law of 75%. And the employees, the new jobs that are created, there must be an average hourly wage of at least 150% of the state or county hourly wage. Okay, you must enter into an incentive agreement with Arkansas for this program, but they give you 4 years to hit the threshold. The minimum investments that are really needed for this program depend upon your county tier. And Arkansas ranks every county in the state by tier, and the minimum you need for this program is to spend at least $250,000. The minimum payroll that's needed is $250,000 in gross payroll. So very low targets for certain tiers within the county. The benefits are a 5-year jobs credit that's based on your payroll, an investment tax credit that can be used against income or sales tax. That's also a percentage of your investment spend. Okay, California Competes. The California Competes tax credit has been around for several years, so just a quick recap of that program is it's for companies that are expanding in California, relocating into California, or the company is at risk of actually leaving California, so the state could lose jobs. It is an extremely competitive application process. It's one of the most onerous application processes I've ever seen. It's really extensive. It goes through 4 phases. However, the benefit can be very lucrative. The minimum amount of credit here is $20,000, but the maximum is 20% of the total available funding for the entire state, which is $180 million. Now, that's a lot of money. Obviously, I don't know if they've given that amount to any one taxpayer, but there's a lot that can be generated for one taxpayer depending upon your project. The critical aspect of this program, though, is that the company really needs to explain why they need the credit. The state wants to know why you're requesting a certain amount of money, how that incentive will benefit not only the state, but also the jobs in that state. Again, I mentioned for fiscal year 1920, $180 million has been made available. There are 3 specific application periods, and this is the only time you can apply is during these periods. You see, we're in the last application period of this fiscal year right now, which ends on March 30th. Okay, and again, just to illustrate, this is one of those programs that not only holds people accountable, but it really looks at you to explain why you need the money, and it also asks taxpayers how much money do you need. So this is not a credit that is a calculated formula. When you go through that evaluation and application process, you tell the state, this is how much money or how much benefit that I need in order to bring that project to the state, or this is how much I would like to receive. And then the state will evaluate that against these factors here, which are, job retention. Is the state going to lose any of these jobs? What's the economic impact to California? Is this a competitive project with another state? Are you getting incentives from another state for this project? Are you considering moving outside of our state? For this particular area that you're expanding in, is it going to help our unemployment situation, or how important is it to that location? So it's a very different process which is commonplace for California, right? California always does things a little bit differently. It is an online application process.
All right, before we talk about Colorado, let's catch our breath a little bit and get to our second attendance poll question. Again, if you're here, please click yes if you'd like CPE, and if not, you can click that or just ignore the question altogether. But if you'd like CPE, please click yes while we're there. So, this extensive application and the question of how much do you need, that's a real different kind of process than most of the other states use, where they are actually setting up and saying how much we're willing to give you for X activity.
That's right. That's right. I mean, I have seen companies that have asked for too little money, which is unusual. You ask for as little as possible, based on what you're projecting. You don't always know what your costs are going to be. But I've seen a company that's asked for a certain amount of money, and the state didn't think that was enough for their project, and they were denied on that basis. And then the company came back in a later year with a reapplication and asked for more money, and they were granted it. So it really just depends on the specific facts and circumstances of a particular project. And the state does try to help guide you a little bit in some of that, but it's also things that you have to justify with your financials on. Where do you expect your cost to be? You can't just ask for a lot of money and you can't justify why you need it. They look at financials and bank records and everything.
Right. Okay. All right. Well, I'm going to close this poll now, and we can move on to talking about Colorado and D.C.
Okay, Colorado. I'm not going to spend a lot of time on Colorado. There's no major changes. What I wanted to illustrate here is that there are 19 enterprise zones in the state of Colorado, and the enterprise zone program is probably one of the most utilized programs because it has a multitude of components to it. So within one enterprise zone program, a company can have investment credits, it can have job credits, it can have training credits and R&D credits. It can have employer health insurance. So it's one of those bundled programs that hits a lot of different tax credits within that one program. Okay, District of Columbia. DC really has one program that's out there. They have some really smaller programs, but this is the majority program. DC is looking for high technology companies. They have a lot of data centers in the DC area, in the surrounding Virginia, DC area, and this is one of those programs. It is also one of the programs that has bundled incentives. So you see in the chart where there are certain tax credits that are available. There are also additional incentives, whether that's a reduction in franchise tax rates or property tax benefits as well. But this is a bundled program. Who qualifies for this program? You have to be a for-profit business that's registered in the district. You have to have an office or base of operations in the district with at least 2 employees, and you must derive 50% of your revenues in the district from permitted activities. And these activities, again, if you look at this list here, they're mainly around information technology, web design, software development, internet-based e-commerce type activities. The amendments to the program are as follows. One, this really was an amendment that began in 2019, is that now that qualified high technology company has to be certified. So you basically present your facts that you meet the tax law for a high technology company. That's all done online in an online application. And the state will then send you back a certificate that said, yes, I've been approved as a qualified high technology company, that you attach to the tax return. One change that took effect January 1 of this year is we saw before that there was a reduction in the franchise tax rate if you were a technology company. They are eliminating that reduction, and technology companies will now pay at the regular corporate franchise tax rate of 9.975%. One of the tax credits that's bundled in this benefit as well was a credit for wages paid to qualified employees. It was previously a 10% of wages. Now it is a 5% credit, and the credit now caps out at $3,000 per employee, where it was previously a $5,000 cap. So some modifications there. Georgia, there are a lot of new Georgia modifications and new requirements in this past legislative session. So one such requirement is that now all tax credits must be e-filed. And this is the actual tax return must be e-filed. We've had some issues with tax software in the last year where we've had some issues getting returns e-filed, but any tax credit, any credit that is in the state of Georgia on a return, that return must be e-filed. The credit now also must be part of the tax filing software. So in the past, in the state of Georgia, the state allowed you to attach credit forms to your return that was electronically filed. Now the state has put all the tax forms into tax software, and if you are not including that data in the tax software, you're going to get a rejection of the credit. Companies that utilize credits against payroll taxes in the state of Georgia now have to make those elections online at the Georgia Tax Center. This is really an old rule, but it's worth repeating because you have 30 days from the date the return is filed in order to make those elections. I just want to mention the jobs tax credit in Georgia. There are a number of ways you see here for a company to qualify for a jobs tax credit. It could be based on where your county is located. It could be based on whether your business location is in a particular zone. The new addition to this list is the last one, which is a rural zone or a revitalization zone. There are about 12 rural zones that have been added to the legislation, and you can now get a tax credit for 2 new jobs at $2,000 per job. There are some additional components to that rural credit, but that's just the one for the jobs tax credit. The Quality Jobs Tax Credit Program has been revamped, and the major change to this program is that you needed 50 new jobs for this program, but you had to have created all of those jobs within 12 months. The new legislation gives you 24 months in order to create those new jobs. The additional modification is that if a company is in a Tier 1 or Tier 2 county, you don't need 50 jobs, you need 10 jobs or 25 jobs, respectively, for those counties. The benefit for this is that the tax credit range is anywhere from $2,500 to $5,000 per job, and it's taken against payroll taxes. The last point I forgot to mention is that you now must have an investment of at least $2.5 million over that 2-year period. So this is a job and an investment requirement for this program. This program was not utilized a lot because the calculations were so detailed and hard to comprehend, but I think we'll get more usage out of that program. The next change in Georgia, expect to see a lot of activity around. Effective January 1 of this year, if you are a manufacturer or a telecommunications company that invests at least $100,000 in assets in one tax year, you are entitled to a tax credit ranging anywhere from 1 to 5%, depending upon the county that you're located in. The change is that for companies in Tier 1 and Tier 2 counties can now make an election to use that credit against withholding taxes in Georgia. And this is pretty valuable for manufacturing companies that we've seen in the past that still have losses. They are still holding on to carry forward investment tax credits that they haven't been able to claim. So this is going to be a really valuable incentive. And for those companies that had carry forwards that are in Tier 1 and Tier 2, you can also make an election to use that carry forward against payroll taxes, but only if that company maintains at least 100 jobs and has had at least a $5 million investment, or will have at least a $5 million investment going forward. The Georgia R&D credit, no technical changes to this credit. What I want to mention is something that I see a lot of errors in. When a company is acquired or there's a merger or some transactional activity and that acquired company has an R&D credit or an R&D carry forward, the law states that the new company, the successor company, cannot get transfer of that credit. So that credit is going to be lost at the acquiree level. I see that error a lot. I won't mention the Georgia Railroad credit. It's very similar to the Alabama program. Illinois, there's a small business credit out there for small employers with less than 50 employees. It's a withholding tax credit. Again, another monetizable credit. It's based on the percentage of wages that the employees must work 90 days. That's a new program. Kansas. Kansas has now required a review and analysis of all programs in the state in the last 3 years. So it's going to be interesting to see how they conduct these reviews or audits. We don't know yet, but this just came out. This is going to be interesting to watch. Maryland. Maryland implemented several new tax credit programs for manufacturers and non-manufacturers. Again, this is a state piggyback off of the Federal Opportunity Zone program. Now, this program does not give a state capital gain benefit. What it does, though, is it wants to incentivize those companies that are investing in state opportunity zone areas. So if you are a manufacturer that's investing in one of those areas, creating 5 new jobs, or in a Tier 2, at least 10 new jobs, you may get a tax benefit. Again, you have to apply in advance for this program, but the benefits are multi-tiered. If you are a new manufacturer, you get refundable tax credits. You get property tax benefits. You get refunds of sales tax, and you get some waivers of some fees. If you are an existing benefit, again, you get that refundable state income tax credit again. These are, again, for the manufacturers. If you're non-manufacturers, you basically get some of the same benefits, very tiered. And again, same thing if you are an existing non-manufacturer. So the programs are replicated, but nothing there for retail or adult entertainment. Okay, New Jersey. Grow New Jersey, a very popular program. It expired last year. The new program name is called New Jersey Forward. It has not been enacted yet, but is expected to be enacted any day now. But it's going to give a tax credit for jobs as well.
All right, before we start Mexico, let's stop and get
Okay.
our third poll in. Sounds like Maryland has a very rewarding program, but a complicated program, and that's really focused for those businesses that are filling into opportunity zones within the state of Maryland. Is that correct?
That's absolutely correct. Yes, they really want to attract new business to the state, and Maryland has never really been a state which had a lot of manufacturing activity, so that's really their target industry right now.
So they're really trying to collect more of those long-time infrastructure type projects that would be some long-time employment type
That's
projects.
right.
Well, interesting. That's great. So I know we've got a couple more states to get through, and then we'll hit some federal credits. So I'm going to close this poll in just about another 5 or 10 seconds. If you can go ahead and click yes if you're here and want CEP credit, just to make sure that we have you on record for that. And okay, let me close that, and we can go on to talk about the last couple of states you have in this section.
Okay, New Mexico, a new solar panel, solar market tax credit just came into effect March 6th of this year. 10% of the qualifying cost of that solar system are eligible. We'll skip forward on some that are really kind of repeat opportunities, but Ohio has a new program. Oregon, the only change is they've added some additional enterprise zones, which gives a lot of property tax benefits. South Carolina, this is an interesting program. Jobs tax credit has always existed in South Carolina, but you'll see the change that went into effect in January of 2019. Look how Tier 3 and Tier 4 counties, look at the credit amount has jumped drastically. And some of you may be familiar with the fact that South Carolina is in competition to try to get the Carolina Panthers. And this legislative change was driven solely by the Carolina Panthers. And so some people call this the Panthers bill. But right now in play, a Tier 3 or Tier 4 county, which these are rural counties, can add a $20,000 and $25,000 jobs tax credit. And that's for each of 5 years for adding new jobs in those states. Pretty lucrative. The other thing is South Carolina has a port tax credit. Again, this is for, importing or exporting product through a South Carolina port. They've increased the funding for this program, but they've never maxed out on the funding that they previously existed. They still have funding left over from 2019. So if you are a company that is shipping product in or out, and you increase that port activity over 5%, and have the minimum weight requirements for that port product, then this is an opportunity. And this credit can also be utilized against payroll taxes. The other component to this credit that was added is not only is it for a company that's shipping the product through the port, it's also for businesses that now provide the cost of the transporting of the product through the port. So this is like an add-on component to this credit. Virginia, the new change is they have revamped the worker training tax credit program. Went into effect in January of 2019, and now it's generally going to be only available for manufacturers. That's kind of the target audience. But they want to encourage manufacturers to set up apprenticeship programs and to hire, middle school and high school students, bring those guys in on internships or otherwise as workers to kind of intrigue their minds early on, and you can get a 35% of the qualified training cost for those employees. The last two programs that I'll mention are grant programs in the state of Virginia. These are both enterprise zone programs. If you have a business that you're making an investment in for rehabbing or new construction or expansion of the actual real property of your building or leased facility, you can get a cash grant for that investment. The good thing about this grant program is that you actually apply for it after your construction is done. So right now there is an April 1st deadline for any rehab costs that have occurred in 2019. So again, this is unlike some of the other programs where you have to apply in advance. This is a program that you can apply after your activity occurs. Same thing with the job creation grant. You must have at least 4 new jobs. The business must be located in the enterprise zone. You must pay certain hourly wages for those workers and offer health insurance, but the grant is up to $800 per qualifying new job position. And again, this is an April 1st deadline application for jobs created in 2019.
All right, let's catch our breath here a minute and talk about how some of the federal credits. We talked a lot about the state incentives, but the federal laws have also provided some incentives for increasing jobs or hiring and otherwise. We can't leave these out because sometimes they get piggybacked in the states.
Okay. Just a few minutes on these credits. So the Federal Consolidated Appropriations Act was just passed, and in that bill there are several components of federal tax credits that have previously existed, but they were legislatively, they had already sunset. So this new act extends those provisions retroactively until the end of this year, 2020. So federal work opportunity tax credits, which I know many companies are taking those credits. Again, technically they were not approved because the bill had not been passed to extend those credits, but we know those companies are still generating those credits, and now we can take them. Disaster retention tax credits, there are 29 federal disasters between 18 and 19. So unlike prior years where we had, Katrina and Maria and Irma, some of those disasters, companies are now able to take tax credits for these disasters in 18 and 19 when their business was inoperable, but they continued to pay their employees during the downtime. Indian credits are also now available, empowerment zones, and paid family leave. These are all essentially hiring-based credits based on the location of the business being in an empowerment zone or on an Indian reservation, or whether you have employees that are members of an Indian tribe. So again, these are all now extended and can be claimed.
Right, and we can't. Let's put up this last polling question before we let you wrap up with the takeaways. So, if you're present, please check yes, and so that we can have a record. We do not know yet how Congress and the President will finalize bills and incentives to help employers to battle the COVID-19 virus. But they could be piggybacking on to that retention of employees during a disaster type program or create a new type of incentive, and we may see the states follow suit on that. So another type of credit that may impact many different employers. We'll just have to keep an eye out for what happens in the next 30 to 60 days to see how those incentives may play out, both at the federal level and at the states when it comes to dealing with the coronavirus and employees. All right, I'm going to close this final poll and then give us a few takeaways from today.
Okay. So, with the majority of the programs that you've heard about today, just in the updates, The key to the states are going to be new jobs, and it's going to be new investment activity. Those all equal credit and incentive opportunities for your company. And again, keeping in mind that we're only talking about the updates that have passed legislation in the last year. There are other significant programs out there, whether there are R&D credits in every state, again, ports credits, training credits that we haven't seen any updates to, but that still exist. So I think, the takeaway is also with the majority of these programs is that you really have to consider what some of your projects are going to be in advance, at least in advance of you hiring jobs or leasing locations or spending money on the assets. If you can prospectively or strategically plan for those projects, I think you'll be able to generate a lot more benefit. And I like to tell companies, just make C&I planning as part of your annual review and just looking at what might happen going forward. Also, looking back is useful as well. Oftentimes we find that companies have missed an opportunity on a tax credit side, and we're able to go back and retrieve some of those because the statute of limitations is still open. So a retroactive review can also be very fruitful for a company to just look at what activities we've had that could have generated credits and that will also stay forefront of mind for as you think prospectively about opportunities going forward.
All right, great. And if you'll switch to that last slide so people can see how to reach you. We thank you all for your participation today. I don't see any questions in the question pod. So with that, I think we will end, seeing as how we are close to the end of our time. If you do have questions, please reach out to Ann. She'd love to hear from you and has a wealth of experience dealing with many of the states and their various programs. And if you've got some particular questions about a program or have your company is planning to expand or move in a direction and want to see what's available, please reach out to Ann and she'd be happy to help you think through that process. That's it for today. Thank you all for joining. Make sure that you have downloaded a copy of the handouts if to help spark your memory on different programs and things that are available. And there'll be a version of this, a recorded version of this presentation on our firm's website in a day or two, in case you want to go back and check into a different piece that Ann talked about. Thank you all for your attendance today, and we will see you next time.